Hello and welcome to FinTech Impact. I'm your host, Jason Periera. Today on the show, I have Doug Ricket, founder and CEO of PayJoy. PayJoy is an online platform that started off by helping people finance cell phones, and now they've turned it and basically are helping people finance everything without a credit card. And with that, here's my interview with Doug. Doug, thanks for taking the time today.
Nice to meet you. Great to be on. Thanks, Jason.
Doug Ricket of PayJoy. Tell us about PayJoy.
Sure. So PayJoy, we are an emerging markets focused lender. So that's Mexico, Brazil, South America, South Africa, getting going now in Asia, in Philippines and Indonesia. Just got our license in India. So basically the global South. We started by helping customers be able to finance their first smartphone. And the interesting thing is in this part of the world, not everybody has access to a easy pay-as-you-go plan. And so that's what we invented. And then the phase two is now we're using that phone as security to provide credit for everything for our customer to become financially successful and stable in life.
So there's going to be a lot to unpack there, but let's talk about the history. How did you get started?
Sure. It connects to my background in that I grew up in tech. I grew up here in Silicon Valley into everything tech, followed that through to MIT because it had tech in the name. But while I was there, I met all these international students from around the world and felt like I had to see a little bit more of the world before jumping into a career. So I joined the US Peace Corps that sent me as a volunteer teaching in West Africa. And that experience really anchored the second love of my life of international development. And I've been looking for ways to merge technology and international development. Did that a bit at Google, helped take Google Maps international, and then stumbled on this thing with a good friend of mine, started a company called D-Light that was doing solar. And I wanted to help bring them to Africa and moved there and started Africa distribution. And we found this problem of affordability where a customer couldn't pay for the whole thing up front. And so my idea was to change into these small little payments step by step. We launched that and D-Light took it to over 100 million customers served, benefiting from their pay-as-you-go solar. And then that was the inspiration for me a few years later with a classmate from Stanford Biz School to start PayJoy and say, hey, we can do this pay-as-you-go concept for all kinds of things, for smartphones, laptops, televisions, microwaves, dishwashers, etc. We can program it to shut off. You make a payment, it turns back on. Now it's pay as you go. We started with the smartphone as that number one hottest product, and we've done about 16 million customers to date. And then from the smartphone, from buying the smartphone, if that's the mortgage, we found we could also do a HELOC, except it's a phone equity line of credit. So anyone who already has a phone, whether they bought it with PayJoy or not, they can secure that phone as collateral and we can lend them money for anything else. So we started with kind of these one-time cash loans, and we've moved it to actually include a credit card now if they want as part of their credit line that they can use for anything. And the mission of PayJoy, we're a public benefit corporation. Our mission is to open the door to financial access to the underserved in emerging markets. Credit, I've seen, is so powerful in both good times and bad. In bad times, if something bad happens to our customers and they're often just on the edge of falling back into poverty, credit says, hey, you had no income this week, you can still buy good food for your children. That's so powerful. Or your motorcycle that you used to get around broke down, like you can get it repaired and the income it will generate for you lets you pay it back over the next 6 months. We've seen a lot of our customers are small micro entrepreneurs, and for them, $100 of credit is inventory in the morning. They can sell that for $150 in the afternoon. That's a great use of credit, kind of financing these people to get ahead day by day and find financial stability and financial success is what we're about.
So lending to developing nations is always been a difficult thing. And too often debt is seen as a negative when it can be, when used wisely, a massive enabler. You give a perfect example. And the reality is that trying to operate a business or your life without the access to debt can be incredibly restrictive. And this is what people live with on a daily basis in developing nations. There's lots of reasons for this, and we can dive into a bunch of them. But let's just simply start with the easy one, with the obvious ones, which is Western society. We typically have credit rating agencies, companies that monitor our credit on behalf of major institutions and can actually help people understand, or companies understand, if we're a good lending risk or not. That doesn't exist in most developing nations. So I think the real question comes down to, talk to me about how you solve for the problem of identification and creditworthiness. How did you determine who to lend to?
Yeah, exactly. So it's interesting. And this is the core problem. I'll give you a micro aside on PayJoy lore. We actually started in the US, focused on the underserved, but it's a slim segment in the US, 10% of the population that doesn't have a credit history today. And we found a lot of our best customers were actually immigrants from Mexico. We followed them back to Mexico. We learned more about this problem internationally, that in Mexico, Brazil, South Africa, India, the credit bureau does not cover the whole population. And so our initial technology trick or gimmick was securing the phone. Securing the phone, and we knew smartphones, there was such pull for smartphones. When we looked at all those products, the number one hottest thing people wanted to buy this year, if they got a little more money, was a smartphone, anyone who didn't have it. So PayJoy 1.0 was kind of saying, hey, we can be a part of the next billion people getting access to smartphones for the first time in their life, getting access to the internet at home, getting communication.
We're not talking about like this consumer product that was basically just something else to carry around. Like for most of the world, the internet is achieved through their phone. And
Absolutely.
there was no terrestrial internet before for many of these countries. When we think about the education abilities of the internet and the power of it that we're just taking for granted in Western society because of easy access. The cell phone was the difference between being online or not.
Absolutely. There are some classic, beautiful stories of this, farmers in Africa being able to check crop prices and things. I think there are even some basic things we take for granted, which is we had a customer very early on, very heart-touching story for me, who used it to keep in touch with her daughter, who was in a different country. This is probably immigrant to the US, making money, and imagine you're a close family member and you're not going to see them for a couple years. I have kids now. I can't even fathom that. And being able to have video chat that they couldn't do before is just amazingly powerful and such a big part of the world today. In some sense, I think our problem now is too much smartphone usage. And when my kids are going to go to middle school and high school, and like, how do we balance smartphone usage? And people, I get on the train, everybody's staring at their phone. It's like calories. We have an excess of calories, which has led to obesity here in the wealthy world. We're talking about another half of the world where actually just they don't have that access. And just as they don't have as many calories, it's a different problem.
So back to the question of how you facilitated this. Walk us through it.
Sure. The very initial prototype with the phone, I remember I was there with my co-founder, Mark Hanen. I was working on recruiting him, and I passed him this phone and I say, here, open the phone. Look, you can use it. And then I went on my laptop and was like, click. And his phone just goes to the PayJoy app and says, please pay your bill. Please buy more time. Your credit is used up. This was inspired on, in emerging markets, there is a history of scratch cards for minutes, for phone minutes. So people would buy, you could go to any vendor, and it was this distributed vendor network, these physical paper cards with a little scratch off under the silver wax seal that had a code, and that code was linked with the phone provider, and you'd enter that code, and now, boom, you have a 100-minute balance. You make a 17-minute call. At the end of the call, it tells you have 83 minutes remaining. And you make another call. Now you have 75 minutes remaining. And when it got down to zero, it would say, you are out of time. And it would shut off, and the customer would have to go buy more. So that concept, that pay-as-you-go, prepaid minutes concept, fit our customers' financial situation very well. That fit how they could manage their money. It was the same as, like back in the solar situation, they used to buy candles. And you can go buy a pack of candles for under $1, and you can see them as you're burning them down, and people could manage it very easily. So it's that inspiration to say, how can we let our customers manage these small amounts of money according to their financial flows? And so that's really how it started, was a prepaid concept. But here you're paying for a week of using a smartphone. And then if you don't have money for a few days, no problem. When you get money, you can turn it on again, use it, and that fit. Like I would definitely say if our customer, their house is on fire or something, or like they have a leak in the roof and it's dripping on them while they're sleeping in bed, they should fix that first. They don't have to pay the phone. The phone can go dark for a day or two. And that's the reality of the situation our customers live in, and they can manage their money. And over time, we want to teach them, hey, here's credit history. If you pay reliably on time, you can build a credit history. We can get you into the rest of the financial world. Someday you can get a car using credit. You could get a house using credit. There's a great world out there for people who get into the financial system.
Yep. Okay. So basically, you cracked the code in one, you basically decided to crack in the other. So you mentioned a number of lending ideas specifically around like business and entrepreneurship. This has been traditionally the target, funny enough, traditionally the target of micro lending facilities. So talk to me about how you compare to traditional micro lenders.
Yeah. So microlending and, things like Grameen Bank, Mohammed Yunus, I think really innovated in this area a decade or two ago. And this concept of, for example, a circle of borrowers who borrow collectively, and they kind of pressure each other collectively to pay back and fill in for each other a little bit. That was a real new innovation. that I think helped open up access to credit. That got some bad press, I think maybe a decade ago, where you had people who had still managed to get themselves in a debt trap and just in a really bad place. So I think that was one step forward that worked in some countries. Still, 2015 was when PayJoy started. We looked at the population in Mexico. It was still 80 to 90% of the total population was not in that kind of elite who had the credit history that we have in the US. And so the problem was still not solved as of 2015. I like to think we're chipping away at it one point at a time, but I think the answer is all of the above, that the traditional microcredit reached some new customers, and still, as of 2015, 80% of the population was not served.
Why do you think that was the case? Where were the friction points that were preventing them from succeeding?
I don't want to overstate my confidence because I hadn't worked in microcredit until I came to it through PayJoy. I'll just say I had not seen it widely deployed. When I was doing the solar in Africa and launching the PayGo, we first launched the PayGo in northern India. I know in theory, microfinance had been there. And I think maybe if we're reading it in the West and we don't live there, we like read an article and we think, oh, it's a solved problem. But maybe that reached 4% of the population or something. So the experience I saw there was still people didn't have access to credit. If they walked into a retail store to buy a TV, there was no payment plan. If they wanted to buy a phone, there was no payment plan. If they want a refrigerator, there's no payment plan. If they want a motorcycle, there was no payment plan. And it was really coming from, as you were alluded to, the credit system was not built out. And lenders who try to lend to this population where they have zero credit history or they're very thin file, those lenders were really not able to make money. I can't really speak to anything that microfinance was doing wrong, except to say I had not seen the problem solved for a massive population. And I think what we did was really jumpstart it from zero for another 16 million customers to date. For people who walked in, they had zero credit history, but it's kind of a chicken egg problem. And we can jumpstart the chicken and the egg at the same time, saying, okay, we'll give you this phone. You will start building your credit history with every payment you make. But how it can work, the magic first ingredient was we secure the phone. So every week it pops up the PayJoy app and says your payment is due. And you can't dismiss that thing until you pay it, except for emergencies, like emergency phone calls and the like. And well, if customers have something going on, they call customer support. We'll give them a day. When there's a natural disaster, we just blast out everyone a free week or something. It jumpstarts it. It keeps honest people honest. And we find it cuts the default rate about in half. So take any given population. And actually, our second big technology has really been, I'll call it predictive AI. The AI wave today is really about generative AI. And this is not generative, it's predictive. But it's super powerful. It's predicting the future. So we can have a customer come in and we can say, hey, we can segment our customers, group A, B, C, D. And we can say group A, we could lend to them and we'll get a 10% group at a 10% default rate. Group B, 20%. Group 3, 30, group C, 30%, 40%. Whatever it is, by putting the phone security, we can bring that default rate down by half. And so for a lot of customers, this means we can then offer them a price which is attractive to them. And some of the responsible lending principles we've developed are always 100% transparency to the customer. They should know, hey, I could buy this phone for $300 cash today, or I can finance it. It's going to cost $500 over the course of the year. That's fine with me as long as they know that. They go into it as a consenting adult. They make their decisions up front. And it can be a lot better for them because, oh, maybe that phone is actually going to let them earn an extra $1,000 this year. It absolutely pays for itself. But the predictive AI technology for credit scoring and underwriting lets us segment those customers, and that initial mobile phone security provides that nudge to keep honest customers honest.
Okay. And that's, you've literally tied the ability to use the thing that they want to, like, you're cutting them off from their cell phone. Of course, you've found a way to do a reasonable carrot and reasonable stick in order to make sure that they're basically doing it. And frankly, you're tying it, especially because it was done originally for the facilitation of buying the cell phones. You effectively basically tied it to the actual product itself.
Exactly. And it's like I alluded to the mortgage. So the reason the bank can give me a great rate on my mortgage, a super low interest rate, is because they have very high confidence I'm going to pay because I'm not going to get my family kicked out of the house. And so the whole thing works better there. A little bit of the nuance with PayJoy coming from that pay-as-you-go prepaid minutes mentality is with us, it's actually okay that customers are sometimes late. Now, we teach them, hey, you want to work hard and be on time and you can build the best credit score. But we recognize our customers who are at the edge of poverty in these countries, broadly speaking, and differences between different parts of Africa, India, Latin America, and people across the income spectrum. But it's okay. We work with people who can have delays, who can have unexpected things come up, and they can't pay this week, they can't pay for a day or two, and that's fine. We can manage it. They can manage it. We have no late fees. There's no accruing interest. There's no increasing debt. And we make this transparent to the customers up front. So if they're going to pay $500 this year for a phone, that $500 price is always there and it's always fixed, even if they miss a week, even if they miss a month. We've had customers go away for 6 months and come back. Someone was in the hospital, they couldn't pay. It didn't make sense for them to pay. They're in the hospital. At some point, yeah, they probably want to wake up and use their phone. But we can be flexible
Mhm.
and we put in safeguards to avoid a debt trap. So for example, with the phone purchase, they can always hand back the phone and walk away debt free. So there's no trap. The door is always open. They can always leave the deal. If they don't like the deal, there's a get out of jail free card. And so some things like that have made it possible for us to do this business and make me feel good about it. I lived in a mud hut in Africa in the Peace Corps. I'm here because I care about the mission of helping people get to a better life. But people always look at us serving the poor and say, hey, are you exploiting them? Is this high cost, taking advantage of poor people? And so we've had to really build these safeguards to get comfortable with that.
The cost thing, it's always relative, right? Like the reality is that we in privileged society look at double digit interest rates and think that they're extortionate, right? But in reality, when you look at the localized market, the options that exist are infinitely worse in many cases, right? So I get it. Like, let's not be exploitive, but let's also recognize the fact that organizing a lot of small loans to a lot of people is a administratively burdensome thing that does have an overhead cost that needs to be taken care of. And B, what someone may consider extortionate here in another country is considered a deal. And it's all about context. Unfortunately, I find that too much of the lending to these communities ends up falling under the guise of our own sensibilities of what is normal.
Yeah. And I think sometimes this gets me really fired up and angry over where regulatory interventions effectively kill the market. And it comes across because I see it as patronizing, where a regulator may say, oh, you can't do it this way, you have to do it that way. But if that doesn't work and no business is going to take that thing because they would lose money, and then you have zero
Yeah.
customers getting served. And we'll see that, for example, we'll see ways that fit with that. So, for example, there's one country we operate in where there's an interest rate cap and it seemed pretty low and it seemed like a prime rate like you'd have in the US. And so when we started operating there, working with a partner, I was interested and said, oh, how do we make that work? Because we can't do a 15% interest rate. I have probably a credit card in my pocket with a 19 or 24% interest rate or something. How does this work in this emerging market country where the average income is $3,000 a year? And people live, all these customers in the informal sector. And what we found there was lenders who operate, they have that piece as interest, but then they'll add an application fee, a technology fee,
Right.
a service fee, late fees, and insurance. And I thought, oh, this is like handset insurance. We're selling handsets. No, it was life insurance.
Huh.
It surprised me. It was life insurance. If the customer dies during the loan, it pays off their loan.
Yeah.
Insurance can actually be arranged so it makes the whole thing economical for the lender. And so when we operated there, we try to make it clean, have few fees, have everything 100% transparent to the customer. So they say, again, it's the same deal. It's, hey, you could buy this phone for $300 or you could finance it over this much time for 400, for 500. Have the total economics clear to them. And if the industry norm is you bake in a chunk of it as life insurance that pays off your debt, great. We'll operate that way and just make sure it's clear to the customer and fair and they still have the get out of jail free card and everything clear up front.
Yeah, I mean, it's funny. Regulation can be good, can be misguided, just like anything else in life. And to think that, okay, you pass a cap, okay, you solve that problem, but then if you made it impossible for capital to earn a reasonable rate of return, they're going to do one of two things. They're going to exit, or they're going to find ways to get that return somewhere else. And unfortunately, that can lead to negative implications compared to what the higher interest rate would have been. It might have been cheaper because
Yeah.
you got to think about it. Every successive way that these companies had to figure out a way to make more money, that added more and more layers of administration and bureaucracy, more and more overhead.
Yeah.
So is it possible that they wanted to cap it at 15 and before the number was 18? And you know what? By the time you're actually done the math on all this other stuff, it ends up costing the person 20. Absolutely, it's possible.
Yeah. And I could see regulation making sense for things that we really say this should never happen under any circumstance. And it's better than, oh, here you're lending like gray market, black market, money lenders. You don't pay, they're going to come break down your door and beat you and break your legs. Right. And so I could see regulation saying that's illegal. Just like beating someone up and breaking their legs is illegal. So that should be out of bounds. But I think beyond that, where we've had people question, hey, what is this? They lose access to their phone. Keep in mind, if we're financing this handset, if they have an old handset, they can always use that. It's financing this particular thing. They can always exit the deal. They can always hand back the phone, walk away, go back to whatever they were doing before. Essentially, what we found, there would not be, if the market was functioning well, there would not have been this gap where millions of people need this thing and are currently unserved. And if they're unserved and they're taking our deal, it's because it's a better deal than anything anyone else is offering them.
Yep.
And either their backup deal was, hey, go to the black market lender and they're going to threaten to break your legs or break into your home and steal your TV back, which is another thing we found, or put aside breaking your legs, but just go to people buying a TV. And we had some major retail chains that are known for really aggressive collections tactics. And they will say, if you're 1 day late on your TV payment, the next day a guy shows up in a motorcycle, legally can kick down your door, enter your house, take your TV, your children are there screaming and run away with it. And I would say our thing is much more customer friendly than that. We're like, it's defined for people. Hey, if you don't pay on Tuesday and your thing expires, you can leave it off on the desk and you get money on Wednesday or Thursday, you can turn it back on again. And we find that transparency of how the whole thing works. Customers get it, they can work with it, they're happy. They buy one phone, they come back for another. They get onto our credit line, product, credit card. They can start using that now for online shopping. That's really exciting to me, part of the electronic wave for us. Like a lot of stuff that we got in the 90s and the early 2000s, still like online shopping is not prevalent in so much of the global South, this underserved population. You have this elite 10 or 20% at the top who have a white collar job. They sit in an office, they work at a computer like I do. So some of these things are so big. Online shopping, hey, just from that, now you can shop around, you can save money. That money has a really high value. There's a high time value of money, that opportunity cost. And so that's where we see this thing really playing where it has not been solved yet, where people had an opportunity to do really well with the phone or to do really well with credit offered to them. And either the downside or the upside, there's a really high time value of money that can make a positive difference in their life.
Yep. At the end of the day, I think there's a potential negative stigma to these people defaulting. It's as if too often it's looked at as, well, these people are deadbeats or not paying their bills, when in actuality, most people are trying to pay their bills, as we see in the data, but something in life gets in the way, right?
Yeah.
To have such stringent rules as the example you gave of, oh yeah, like literally next day someone can come and beat down your door. The reality is that lending is a basic functional need of any market, like even developed, not just developed markets, but developing markets too, in order to facilitate life cycle needs of cash flow. It's just a thing, right? And to think that we can regulate it fully to the point where, okay, we're going to make sure no one's predatory, no one's doing anything because you're squashing out something, you're potentially creating opportunities for something worse.
Yeah. And we've been fortunate. We haven't had huge problems with regulation. Some of the things that I've seen in some jurisdictions that we've been able to find ways to be regulatory compliant, but that could be a problem are things like if we had to follow really slow and burdensome practices that were built for a mega loan or a loan that we would consider for a $5,000 loan and apply it to a $10 a week payment, it's not a weekly payment. It's not going to work. If we had to give the customer notice for 2 weeks and then do a court filing and this, we can't do that every week. And so we've been lucky to find the area where we operate in. Again, it's tech facilitated, so it's not a heavy burden on our side. We don't have to pay giant collections. We don't have to file fees and run a giant process. It's clear and upfront to the customer, so they know what to expect. They know how it works, and there's flexibility. Hey, if you can't pay for a couple days, it's fine. When you come back, You don't owe any extra interest. You don't owe any penalty fees. The number that was agreed on at front doesn't change. And I think that's where we've seen customers be afraid because they've heard of some of this stuff in the past. So for example, when we did customer research on credit cards in Mexico, what I heard was from some customers was feedback like, when the last credit card came to my neighborhood, the people who got that, it didn't end well because they built up debt, they got in a debt trap, and it turned ugly. And I'll just mention again here, this is where our second technology has been really powerful. The first was the smartphone security, but the predictive AI, the machine learning for underwriting and risk assessment lets us get the right amount of credit to the right person at the right time and say, this customer can handle $300, this customer can handle $100 of credit for what they can successfully, safely repay. Then they pay back on time. If we get it wrong, we give too much credit and the person takes it and they default, they get a bad credit history, we lose money. If we don't offer enough, it's not attractive. This is someone who is good for $500, we only offered them 50, they're going to walk away. So I like that kind of aligns the company's interests and the customers. Our goal with AI is be as smart as we can with our underwriting, be as smart as we can, predict what is the right amount for this customer, get them onto the credit system with high probability that they can repay. And then that chicken and egg cycle takes off from there.
Good. So before we wrap up, there's 3 questions I'd like to ask on a positive note. First question I'd like to ask is, if you had one wish for something to change in your company or the industry as a whole, what would it be?
One wish for something to change in the industry or the company. I guess I would hope on both sides actually for more speed. I'm proud that we've reached 16 million customers. And one thing we're trying to do now inside the company is learning how to be fast and big. We're not that big, but we could go public in a couple of years. We're going to hit $1 billion revenue probably next year, good profit numbers. And so, where we're adding compliance and we're getting our accounting in order and everything, a little bit, we're getting bigger. And I hope we can still stay fast because there's a few billion people out there in the world and 16 million is not even 1% of that. So we have a lot of growth ahead of us. And we have to figure out how do we scale things into the many millions. And for the industry as well, maybe for these countries, I would wish them to be welcoming to fintech innovation and lay the ground rules that like you can't break anyone's legs. But, beyond that, let consenting adults figure out what kind of commercial options are available and how to structure it and how to time it and innovate and make something better and faster and cheaper. And competition will make it better and better over time. My hope there is really for speed because all of the unserved customers are still living their lives unserved. Every day that goes by, I wish them to get good solutions as quickly as they can.
Second question is, what's been the biggest challenge in a company where it is today?
The biggest challenge in our history or that we're
Yeah, in your
facing
history.
right now?
Either that, either or.
We pivoted in 2020 for a few years, we thought we wanted to be a pure software company when we grew up and license our tech, the smartphone security and the data science for underwriting. We licensed those as software products to other lenders. And we had a crisis that we had to figure out whether to stick with that or to shift in 2020 back to us as the lender, which was our original business model. And we shifted back to being the lender, which is one step more vertically integrated. We bring the capital, we take the risk, but we earn the reward. If our software security works well, we're more profitable. If our data science is more highly predictive, we earn more money. If we screw those up, we will pay for it in the actual performance of the whole lending operation. That one was a really tough choice. But in hindsight, I think that making the choice to come back to being a lender was a big part of our growth of the last 5 years from 10 million revenue to hundreds of millions.
All right. And the last question I have for you is, what is it that keeps you getting out of bed in the morning to fight the good fight that is entrepreneurship?
Yeah, I'd say it's just our mission. We're a mission-driven company. And so the mission to me means I get hit by a bus tomorrow and I'm like, this is exactly how I wanted to spend these 10 years of my life. Like nothing else I would have rather worked on. I would say my priorities in life are probably family first, work, and then everything else. And so getting clear on that, I feel super grateful I don't take this for granted that it's a given in the universe, but somehow life has been able to let me be present for my family and my kids as they're growing up and be home for family dinner every night. And during COVID, my younger son was probably what he would have been like 3, 4 years old at that time. He'd come to my room every day at 6 o'clock, bust through the door and say, "Daddy, dinner time." And I'm grateful I was able to shut the laptop, walk down the hall, and be with him and them, and that PayJoy has allowed for that. And PayJoy too, that it's something that I believe in so strongly. Like, this is why we're here. And I think everyone at PayJoy, it's let us attract employees who care about this thing. And when we get that fit, they're like, yes, I'm doing something meaningful with my life. This is worthwhile. And it makes the work easier and more pleasant. And it's not painful work. I have to go, whatever, dig in the mines and I'm dying of coal dust or something. No offense to miners, but like, it's a thing that people can really feel good about. And we get people who either this has been their lifelong dream and they've never found a way for it, or they've gotten to mid-career and they were feeling a little lost and bored. And now they can find something that this is the mission. This is what we're about. And that's at a company. This is part of us shifting to be a public benefit corporation. It's really stamping in our whole corporate charter, our mission, and equal to create shareholder value as a company is serve our mission, serve our customers, help them into the modern world. And that brings us together and helps make it all worthwhile for me.
Excellent. Doug, thank you so much for your time. Greatly appreciated. Keep up the good work.
Thank you so much.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonperera.ca.